Hey, before we move on, we've got one question over here that's popped up. If carbon credits are granted for economically viable wells only, what additional incentives exist for operators to help offset P&A costs and lose profit? So really what we're focusing on over here is marginal wells. So really what the incentive is kind of the arbitrage between the value of the remaining reserves and the value received for the carbon credits. The current view in the market is that the carbon credit price will continue to rise as emission reduction targets loom nearer, primarily in 2023. And really the only price differential that the carbon value of the carbon credit is competing with is the profit margin. So if you're producing a barrel of oil, there's a certain cost per barrel to produce that, and then you receive a certain amount for that barrel on the market. And that profit margin is what the carbon credit has to do, because obviously the carbon credits have no operating expenses. And so the additional incentive for operators to shut in the economic wells is really making a case-by-case decision on, does this well create more value for me if I continue to produce it? If this is a new well with low operating expenses, that would be the case. But on many marginal wells where the profit margin is narrow, then perhaps there is greater value in retiring it early, offsetting those emissions and receiving that carbon value rather than continuing to operate. So we have another question that's popped up. What price forecast is used to determine the economic limit of the well? So for the value of the well itself, we use SEC price determinations, which is the first month of the last 12 months arithmetically averaged together from whenever the project is being initiated, and that determines kind of the economic limit. And then we take all the economics of the well, and when it comes to, and then what price for a carbon credit would be required to basically equal the PV10 value of the oil and gas asset. So that is kind of what factors into it. Of course, I mean, we're not going to be targeting just the break-even price for the credits for what we receive on the market. We believe there's a good price expectation for these engineered credits, and it is above kind of what maybe we have seen from the nature-based credits on the international market, which can range from $2 to $7. But what we have seen domestically, much higher prices for US-based projects and high-quality generated carbon credits, which meet the criteria. Hence the focus on these core criteria, which we know will return a higher value to the operators for their projects. Another question: is reserve simulation required for marginal well certification of permanence? It is not required. It is simply a suggestion. We all know that there's certain with geologically well-defined reservoirs with good boundary conditions. Some of our existing projects, they have fault blocks where they have measured pressure data, and they can clearly demonstrate lack of pressure connectivity with offset fault blocks, or it could be perhaps there's an anticline structure or some other geologic constraint. So reservoir simulation is not required. It is only a suggestion. So it may be that the drainage area is well defined and all the wells within that are plugged, and so there's no question of connectivity to offsetting production if there is any. So that's simply a suggestion, and we're happy to discuss specifics on a one-on-one or project-specific consultations to perhaps come up with a good narrative for permanence. One more question: is having those restrictive covenants not making ZeroSix's approach less competitive? It is we don't believe it makes it less competitive, but I mean, it makes it higher quality, which really, I think at this stage in the voluntary carbon market, where we have seen the credibility really hindered by a lot of additionality failures on so many projects across the industry, we believe that additionality is a really key component, and providing that protection, that guarantee to buyers that the reserves that they're potentially purchasing over here, or the emissions that they're offsetting, won't just be brought back online in the next 5 years, 4 years, when the price of oil goes back up, let's say to above $100, that somebody else won't just come in there and drill a new well, which is unlikely to happen since we're mainly targeting marginal wells. And so for a lot of the projects we're looking at and evaluating and moving forward with, this is not really a strong consideration, since these are fields that are in their late life, and there's really very limited reserves remaining in the ground anyway, and wouldn't really make sense to redevelop. So it's really not so much of a surrender for the mineral owners or the operators, but it really does add a very, very high value add to the buyers, as well as the potential price received for the carbon credits themselves. And the declaration of restrictive covenants is simply one mechanism that we've developed and proposed to operators, but really it is or equally binding legal barriers. So in certain cases, there could already be existing regulatory restrictions on new developments for whatever reason, or other barriers. But this is a little bit open-ended, but we do have some mechanisms to prove up that legal protection. But we do think fundamentally it is core to creating these high-quality carbon credits and giving buyers that long-term confidence that these will remain high quality going forward.
Yeah, thanks a lot for that presentation, André. We have some more questions in the box open here. All right. See if I can bring you to me so you can see them as well.
Perfect. All right, so another question. Can you please confirm that carbon credits can be generated by PDP, PDSI, PDVP? What about PUDs? So as I mentioned in the additionality section, currently we're really, since this is such a new technology and we really want to make the voluntary carbon market comfortable with this premise of retiring oil and gas and really giving value for abating those emissions before they even enter the value chain. We feel the most confident about selling to non-industry buyers that develop producing and perhaps even proved shut-in, but developed reserves with an easy access to be delivered to the market and result in emissions are the easiest and highest quality to deliver and sell as additional. We're not currently giving credit for proved undeveloped because there's a significant barrier for those emissions to enter the market. That is not to say that is not something that we will not be pursuing going forward once the market is tested and established, and we can create that narrative and create a good case for that additionality amongst the buyers and the general public. Next question. So just to be clear, you have no allowance for leakage, correct? That is correct. We don't believe that there's right now that there's any need to include the leakage in this methodology. That is correct. Based on the macroeconomic justification that I went through. However, we're also very conservative and quite conservative in our valuations, such as the carbon intensity of the reserves being credited. If you look at existing methodologies, they often include project-specific emissions, which include like operational emissions as well. So we don't believe that giving additional discounts for leakage is really necessary at this moment. Can you compare and contrast direct carbon storage tax credits versus your token? So carbon credit tax storage, those are obviously government issued for very specific projects. And through the voluntary market, you get direct compensation, not just tax credits for the credits being issued. And so this creates a little bit more dynamicity for that, and you have multiple buyers, and the price is not fixed by a central regulatory agency, and thus is also a little bit more open-ended to what projects can be can be qualify for these credits. Next is, it appears that there may be a glut of voluntary carbon credits on the market with posted prices coming down rather rapidly this year. Can you speak to the buyer market at this point? So currently, obviously the voluntary carbon market this year has been discredited a little bit through information coming out about the lack of transparency and the low standards, or perhaps not as transparent or as strict standards by the projects that were brought online 10 years ago or over the last couple of decades. And that is something that we're trying to address over here. And like any market, there may be some fluctuations in supply and demand, but supply has gone up drastically over the last 2 years, but largely through forestry projects. And so the market suggests that they are in search for higher quality credits, which includes these engineered solutions such as ours. So we believe that credits coming from platforms such as the ZeroSix will not be in direct competition with the general, what we consider lower quality credits, which are currently swamping the market. Are the costs to P&A the well also considered, or just their reserves and economics? So this is a factor in the break-even price that we determine upon looking at specific projects, and we most certainly do consider the P&A costs, because obviously that is the biggest cost in executing these projects. In a normal PV10 evaluation of an oil and gas project, operators try to defer the P&A liability as long as possible and hence discount it. But obviously, if to execute this project, that cost is front-loaded to the immediate or near future. So yes, we definitely do consider it in determining the break-even prices. And even with this consideration, we find that the break-even prices are quite competitive with what we expect to receive for these credits on the open market. Oh, it's a long one. How do you account for internal leakage? If you remove my asset retirement obligation, I imagine I would use those new available resources to rework or increase production on another well. This is not the reason why ever I couldn't accredit this.
I think
this is,
Sam, in our back channel, Sam Holroyd also had some additions on leakage. So maybe Sam, if you want to take a question and also your addition, if you don't mind, Andre.
I'll go for it.
Surely. Yeah, thank you, Jose. Andre, great work. I thought I might just maybe provide a little bit of additional background on leakage. So in the marketplace, we think about two separate types of leakage here. We think about the market leakage, which is, I think, what this question might be getting to, but there's also the operational leakage. As required by many of the registries, there is operational leakage addressed within the ZeroSix protocol, and that is accounted for within our buffer account. So we do reserve a small portion at this time, 1% on most of the projects we've looked at is considered a buffer account, and that is a leakage, if you will, an operational leakage consideration. Those credits would be attributable to the operational leakage. Market leakage is something that is quite of a broad question, and the voluntary carbon market is addressing that in a variety of ways. Some of those have to do with pricing, some of those have to do with the buyer-seller relationships. To maybe cover one of the other questions here, that the owner of those credits is the generator of the credits, the project owner. So you will own those credits and you would sell those credits on your own. And so when it comes to the market leakage, reassigning those values and those investments to more oil and gas development is truly a relationship that you would have to address, but directly between yourself and the buyers. Koos, I'll turn it back over to you. Oh.
Yep. No, that's a very good point, Sam. And so that is also something we haven't really addressed here, is really kind of the co-benefits of these projects, which is something that's also going to be captured in the non-fungible part of the token that is issued. And that is something that can really play a big part in playing helping the narrative of the credits, which is something that drives really the price received among buyers as well. They really want to feel good about the carbon offset impact that they're having with their investment. And we feel that kind of cleaning up older oil and gas production facilities, that maybe having some leakage issues, or just simply having older facilities on landowners' surfaces or in natural environments, that is a very positive story to tell. If you go from an oil and gas operation, even if it is operated cleanly, to simply back to its natural state, that is a great thing to show, especially if there's improvements in cleaning up any soil contamination, air quality contamination, elimination of the methane leaks, water quality, etc. And so this perhaps use of funds is also something that is really a consideration, and ultimately as a co-benefit to what buyers may look at. So some of our pilot projects, obviously they have other operations that they're focusing on, whether it be conversion to CCS or efficiency improvements or other alternative energy sources. And so if this is something that is the use of funds that can be documented as a co-benefit, that'll command a better price for the carbon credits themselves on the amongst the buyers.
Right. Thanks, Andre. And then I think we have some questions on the demand side, and in the back channel, we're also communicating with our CEO, and he's very happy to take those. So I would also like to introduce Martijn Dekker, who is our CEO. And maybe the first question for you, Martijn, is does the operator sell the credits, or does ZeroSix sell the credits? And whether we have sold any credits and what the price will be.
Yeah, great. Thanks, and thanks for all attending, and happy to answer that. So I think Sam already mentioned is that as an operator who's creating these carbon credits, I mean, the credits are yours, and you can do with it whatever you want. You can sell them, you can keep them, you can retire them. As Andre mentioned, the first credits are to be minted in the summer, in like July or August. So at this point, we haven't sold any credits yet, and that'll be actually a key point to establish the pricing point as well. As Andre mentioned, actually, although the global carbon voluntary carbon market is taking a little bit of hit because of the bad publicity on particular nature-based solutions in the beginning of the year, pricing for carbon credits from America is pretty strong. And I think the last report I saw as far as like international market is around $5 per ton of CO2 on a variety of projects, regardless of quality. In the US, it's more like $25 per ton, again, regardless of quality or the type of project. So I think that's kind of on the selling the credits. In terms of the model for buyers and suppliers of carbon credits, is we only charge like a nominal fee to get to make use of the platform. So there's not a lot of upfront cost. And as a supplier of carbon credits, basically you get compensated as we get compensated, because we just get compensated as part of the carbon credits. So that's actually not any money out of your pocket. And I think for buyers, they can either buy directly on our platform, or you can bring your own buyer and you can take the credits off our platform and sell them to whoever you want, or work with any brokerage or platform you're already working with.
Great, thanks a lot, Martijn, for answering that. Maybe two more questions that are appropriate for you to answer as well, which we probably can take together. So the compensation of ZeroSix, and then we have a question about the ZeroSix revenue model, and where the ZeroSix platform adds to the cost to either producers, buyers, or other participants.
Yeah, I think I kind of answered that. Is like the way we really compensate it is by retaining part of the created carbon credits. At the moment, 15% of all carbon credits created we retain as compensation, and that only happens when the carbon credits are minted. So there's no cost to producers or buyers ahead of time. And to use the platform, there's a nominal fee, and actually what we've done, we've basically set the fee on the size of your production. So if you've got a big operation, you pay a little bit more, and if you got a small operations, you pay a little bit less, to make it accessible for all shape and forms of producers.
Great, thanks a lot, Martijn, for the clarification. Then I think there's some questions to you, Andre. I think maybe, let's see, we have a question on the ACR methodology.
So it is comparable, not directly comparable, but in terms of the requirements and standards, yes. And I would say even more so in certain elements. But I can also take this question over here on the scope 1 emissions for the workovers and refracts. That's a very good question. And that's not really, since we're not really directly accounting for operational emissions right now due to the complexity of those that I mentioned earlier, it is definitely something that we will be implementing in the future. However, with offsetting a workover or refract operational emissions that might have happened, that's something that's perhaps like behind pipe reserves or currently shut-in reserves. So I think giving credit for the remaining reserves that would have been produced as a result of that workover or refract So that's a positive. And I don't think right now we would be crediting the work over execution emissions or operational emissions or the refrac ones, just because that is kind of outside the scope of our current protocol. But in the future, that is something that we may definitely consider and factor in as we become inclusive of all emissions.
Great, thanks. I think the majority of the questions here are also right in your alley, Andre. So feel free to take any that you want or refer them.
Okay, I think a buffer pool of 1% of a forestry protocol is supposed to account for impermanence, reversals, risk, control leakage, and uncertainty. What formula was used to determine the this low of a number? So it was really consideration of the risks across the potential reversal risks across the projects, and similarly, like the considerations whether it was things that could have, whether it be a leakage up from a abandoned well, whether it be seismic activity, whether it be somebody coming in there and redeveloping them. So we looked at each of these risks and the likelihood of them and the potential impact. And so the one thing about oil and gas operations, even actively trying to produce the reserves results in a fairly low depletion rate. If we know anything about oil and gas projects that take many, many decades to extract the reserves. So we know that the rate of leakage, should any occur, would be very slow. But also, if a well is properly abandoned according to local regulations, we know that the leakage around those is extremely low. And so that is a very low probability risk as well. And with the legal protections and other protections and accreditations of that permanence that we've required for projects that go through our protocol, we think we've addressed a lot of those risks that might potentially result in a reversal. Thus kind of looking at the risks that were presented. And for example, I mean, if the forestry project protocol is mentioned, there's a lot more forest fires around than there is open leakage from existing reservoirs. So it's understandable that it would be significantly less than that. So, and to be fair, it was more of a comprehensive qualitative assessment of risk and the impact than a specific empirical equation, perhaps like for the carbon emissions themselves. But happy to go into details, perhaps maybe a subject of a future article.
Yeah, Andre, Sam here. I just wanted to maybe build on your comments there for that buffer account presumption. So we went through quite a bit of assessment against some frameworks around defining risks and how those risks are considered in each of the different types of carbon credits. And I think the key consideration for this particular protocol is really embodied in the fact that the oil and gas market is a mature and highly regulated marketplace. And with respect to the abandonment of operations, highly regulated on the way those operations are conducted and the operating environment and the filing of paperwork that must be approved, all of which has to be followed to generate carbon credits on the ZeroSix platform. And so I think when we looked at following the existing regulations, that was a key component as to the limit and the amount of operational risk that would be associated with any extension of the buffer account. And on a case-by-case basis, we would obviously look at that and see if there were reasons for extending that as needed.
Yeah, thanks a lot, Sam, for that addition. So I see one question on whether we as ZeroSix anticipate that tokens would sell at different prices based on the non-fungible elements of the tokens. And we can confirm that is indeed the case. So we do see that one distinguishing element of the ZeroSix solution is that each carbon credit can be individually recognized and also sold at different price points. And we estimate that a local for local element might be important in this. So for example, somebody in a business in Houston might want to exclusively use carbon credits based from Houston. So then we have another question, which I think is to you, Andre. I don't think we got to that one yet. Out-of-pocket costs for the evaluation of their assets.
So this is something that I think, again, makes the digitization of the protocols fairly unique, and is something that will be a valuable tool in the credit markets going forward, is that it lowers the cost to entry of projects by allowing the operators to really do a lot of the evaluation themselves if they have that internal information already. So it's really about generating the sufficient standard of reporting, whether it be so it's the cost of doing a third-party reserve report that is priced out of pocket, but in terms of doing the permanence, that is up to the operator to come up with themselves, or hire the relevant engineers that have that knowledge and technical capability to create a high-quality reserve permanence report. As for the third-party assessment or verification, that is something that is based on like a flat registration basis. So for an operator to register on our platform, there is a small sign-up fee, and we really disconnect that cost from the ultimate result, because we want to maintain that independence. And so tying the verification to an outcome is something that is that would invalidate that result in a certain way. So the cost can be scaled with the size of the project, perhaps, and the number of wells, but that is the only cost that's really associated around that. And of course, at this point, we're hoping to fully automate the platform, but right now, while we're still getting operators familiar with it, we're happy to do initial kind of consultations and help validate individual projects kind of on a high-level basis to help screen those for the operators that might be interested in pursuing specific ones.
So there's one more question, Andre, and then I think we answered all of them. But I would also, if we missed any of your questions, please answer them in the chat. We have one more minute left to get to those. But there's one more question on the utilization of third-party engineers. So maybe Andre, you can answer that question.
So any valid third-party reserve report is valid and can be considered as long as it is a licensed engineer, or actually the engineer meets the SEC requirements for a accredited individual to be making such determinations. And that is something that'll be part of the review process by Ryder Scott. So Ryder Scott is only doing the verification of the third-party reserve and this report and the supporting documentation, but the actual report itself can be issued by any accredited individual or organization.
Great. Well, thanks a lot, Andre and Sam, for answering these questions. I don't know if you have any last additions before we get to the practical things.
Oh, thank you everybody for your questions and for your time and participation in this great walkthrough of the protocol. Happy to introduce it to you guys, and looking forward to the additional feedback.
Yeah, I fully agree, Andre. And thanks a lot for your presentation. I think it was very insightful. Thanks to the audience for all your questions. I see there's one more question coming in, which we cannot get to now, but we'll make sure to include that in the mirror board and answer the question. Like my colleague Stephen mentioned earlier, we will share the recording of this session and a PDF of the mirror board on your email, the email you used for registration. And you can always contact us through our email address, which you can find on our website. It's info@zerosix.co. Yeah, and I think we covered everything. Thanks a lot for attending. Feel free to, yeah, thanks for sharing that, Andre. You can see our email address there as well. Thanks a lot for attending, and we'd be happy to chat with you further if you have any questions or interest to go further and explore this with us. We'd of course be happy to have an email conversation with you or jump on a call to discuss further. So thanks a lot. Anything else, Andre, Sam, before we wrap up?
Nope, just a big thank you.
Yeah, thanks a lot, everyone. Thanks for attending, and we hope to speak to you soon. Have a great day.